All right, team, welcome back. We've already put in the work on the operational budgets, the plan for all of our core activities. So now it's time to tackle the other equally critical half of the master budget, the financial budgets. This is where we stop just planning what to do and start answering the single most important question in business.
And this is it, right here. You see, an operational budget is your plan for profit. It looks great on paper. But the financial budget, that's your plan for survival. It really doesn't matter how amazing your sales forecast is or how efficient your production line is if you don't have the actual cash, the fuel, to make any of it happen. So let's break down exactly how we make sure that tank never, ever runs empty.
So here's our game plan for today. We're going to start with the big picture difference between planning and reality. Then we'll dive deep into the cash budget, which is really the heart of this whole thing. After that, we'll talk about those big investments, see how it all comes together in the final financial statements, and then we'll wrap up with a clear, focused strategy to help you lock in those points on exam day.
Okay, first up, plan versus reality. This is probably the most fundamental concept we need to get our heads around. It's all about shifting our mindset away from the activities we're planning to do to the actual real cash we have on hand to get them done.
And this right here is the key distinction. On one side, you've got your operational budgets. They're all about planning our activities, what we're going to sell, what we're going to make. But on the other side, financial budgets are what ensure our survival. They focus on the money and, crucially, the timing of that money, turning our plans into the cold, hard cash flow we need to keep the lights on.
So that brings us to the absolute star of the show, the cash budget. I'm not kidding when I say this is the heart of your financial plan. It's also a very, very high probability topic on the CMA exam, so you're going to want to give this your full attention.
The cash budget follows a really clear, logical four-step process. Step 1, cash receipts. And let me be clear, this isn't sales revenue. This is when the cash actually lands in your bank account. Step 2 is cash disbursements, which is when you actually pay your bills. Then, for Step 3, we just net those two out to see if we have a cash excess or a deficiency. And finally, Step 4, the financing section, tells us if we need to borrow money to stay above any minimum cash balance the company requires.
Okay, now here's a pro tip that I guarantee will save you points on the exam. Please, listen closely. Depreciation is a non-cash expense. Yes, it absolutely shows up on the income statement, but it is never, ever in the cash budget. Why? It's simple. You don't write a check to Mr. Depreciation. No cash ever leaves the building. This is a classic exam trap, so please, don't fall for it.
Now, the cash budget is perfect for managing all our day-to-day operational stuff. But what happens when we need to make those huge, long-term investments? Well, for that, we need a totally separate plan, the capital expenditures budget, or CapEx for short.
So, what is the CapEx budget exactly? It's our game plan for buying those major, long-term assets. We're talking about things like a brand new piece of machinery for the factory, a new office building, or a massive technology upgrade. These are typically large, one-off cash outflows that you have to plan for very, very carefully.
And just think about the impact of something like this. Let's say we buy a new factory press for $500,000. Well, that entire $500,000 cash outflow hits our budget the moment we pay for it. Now, for accounting purposes, sure, we'll depreciate that cost over many years. But from a cash flow, from a survival standpoint, that cash is gone today. That's a huge distinction.
And at last, we've reached the grand finale, the budgeted balance sheet. This is where we finally close the loop and get to see how all of our careful planning, every single budget we've made, affects our company's overall financial position at the end of the period.
This is where you see that it's all one big, interconnected puzzle. Every budget we've built feeds directly into this final statement. Where does ending cash come from? The cash budget, of course. Ending inventory? We pull that from our production and materials budgets. Our new net property, plant, and equipment balance? That comes straight from the capital budget we just talked about. And our retained earnings gets updated from the budgeted income statement. See? It's all one cohesive system.
Okay, let's bring it all home and talk about what really matters, your exam day strategy. How do we turn all of this knowledge into actual points on the board?
Here's what you absolutely need to burn into your memory. First, always think liquidity. It's all about the cash. Second, remember that timing is everything. Never, ever confuse a sale with actual cash in the bank. Third, mind the minimum. In a problem, always be on the lookout for a required minimum cash balance. And finally, remember the big picture.
This whole budget is a feedback loop. If your financial plan doesn't work out, you can't just ignore it. You have to go back and adjust your operational plan.
You've done great work getting through this. You really have. You now understand the structure, the logic, and the why behind the financial budgets. But we both know that the key to points on exam day often comes down to the mechanics. So the final question I'm going to leave you with is this. Can you nail the single most tested calculation in this area, the cash collection schedule? That's your next mission. Go practice that. Keep up the amazing work.